You don't need to pitch in front of a boardroom full of investors in Patagonia vests to raise money. In fact, you might be better off without them. Today, we're unpacking how real founders are building their businesses without ever touching venture capital, and why that might be the smartest move you make as an entrepreneur. Let's start with something simple but powerful: using your own money. Bootstrapping. It sounds like a Silicon Valley badge of honor, but at its core, it's just about self-reliance. Maybe it's your savings, a side hustle, or yes, even that emergency fund you swore you'd never touch unless your kitchen caught fire. The point is, bootstrapping keeps you lean, focused, and entirely in control. MailChimp? Fully bootstrapped to a $12 billion exit. Not a single VC in sight. Now let's say you've already got some revenue coming in, just not enough to scale the way you want. There's a newer model gaining traction: revenue-based financing. Companies like Clearco or Pipe offer funds based on your projected income. You pay them back as a percentage of your revenue, not with shares. That means no giving up equity, no board seats, and no awkward investor calls asking why you spent $400 on lunch. You grow at your pace, on your terms. But what if you want money and community all in one? Enter crowdfunding, and no, it's not just for quirky gadgets or indie films. Platforms like Kickstarter and Indiegogo have launched real profitable businesses, some raising millions before ever shipping a product. Then you've got Start Engine and WeFunder, where people can actually invest and become shareholders. The beauty? You're validating your product and building a loyal customer base before you've even opened your doors. Just don't promise a flying car and deliver a scooter with a fan taped to it. Another untapped source? Free money. That's right. Grants. Governments, universities, foundations, they're all looking to support innovation, research, sustainability, social impact. And they don't ask for equity, repayment, or even lunch. You just need a great idea and the ability to fill out a few forms without rage quitting halfway through. If you're competitive by nature, pitch competitions are another path. You walk on stage, tell your story, and walk off with capital. And maybe a few new followers on LinkedIn who suddenly think you're going places. Now, maybe you're not interested in crowdfunding crowds or cold pitching foundations. There's still one route worth exploring: angel investors. Not the ones who want to triple their money in 18 months and micromanage your roadmap, but the quiet ones. The founders who've already built something and just want to pay it forward. They often bring cash and connections. And sometimes the kind of advice you can't Google. Even more interesting, strategic partnerships. Imagine teaming up with a bigger company that sees value in what you're building. Maybe they fund part of your growth, offer distribution, or give access to their infrastructure in exchange for a long-term collaboration. No messy equity deals, just shared value and aligned incentives. It's business dating without the ghosting. Here's the truth: venture capital is just one way, and it's not always the best way. Sometimes raising less gives you more freedom, more creativity, more control. What matters isn't how flashy your funding story is. It's whether your business survives the next 5 years and actually solves a real problem. So if you're dreaming big, but keeping your equity, you're not playing small, you're playing smart. This is Startup Television Network, where we believe the best business stories are just getting started. Hit that subscribe button for more sharp, actionable insights that help you launch, grow, and succeed on your terms.